Hello and a very warm welcome to this week's Out and About. On last week's show, you would have seen financial advisor Bhupinder Anand talking to us all about the importance of making a will. And I'm pleased to say, after the huge popular demand, he's back again on this week's show to talk to us all about inheritance tax. Bhupinder, great to have you join us again this week. This week we're going to be talking about inheritance tax planning. It's something we all hear about. It's something we all want to try and avoid. So let's just start with the basics. What exactly is inheritance tax?
Inheritance tax is a very, very nasty tax.
Right.
Let's start with that. You know, Michelle, throughout our lives, we pay tax. Every time we earn any money, every time we spend any money. Petrol, fuel duties, VAT, gambling for those that do it, alcohol tax, tax on everything.
So the last thing you want is to have another form of tax hit you.
And so the taxman's not happy enough throughout our lives. The taxman's, I should say taxman or woman, of course, but taxman, is also saying, I want you to die as soon as you can, because when you do, I'm going to take another chunk of everything that I've already taxed.
Right.
So inheritance tax is a tax on death. It is a tax that applies based upon the value of your estate. Let's define the word estate, I think, is the first thing to do. Estate is everything you've got.
Right.
Your home is not exempt. Property, cash, investments, cars, potentially works of art, everything. By the way, and this is really important for our viewers, worldwide assets.
Right.
Not just what you have in the UK.
Okay, it's everywhere in the world.
Yeah, so if you've got property in India, Pakistan, Bangladesh, wherever it may be, you may think because it's there, it's not taxed here. But if you've lived here long enough, and that's, I think, 15 or 17 years, the rules have changed.
Okay.
Pretty much if you're a national here, you're resident here, you're taxed on worldwide assets for inheritance tax. And a lot of people don't know that. So be careful. So the tax is a government attempt to try and fill the coffers. And so everyone keeps thinking, oh, well, they might reduce the tax in the future. No.
They won't.
They can't afford to. And certainly after a pandemic, they can't afford to. If anything, the tax is rising. I'll talk about the rates in a second.
Yeah.
Because the allowances you get, which I'll also talk about, have not gone up for a long, long time and are not predicted to go up.
Right.
But property prices have gone up, wealth has gone up, which means more and more people are falling into that bracket. Whereas they thought they wouldn't ever pay inheritance tax, they are.
Okay.
So that tax is payable on death, but everyone gets an allowance. The biggest allowance is £325,000 of wealth, whatever that wealth might be. Anything above that is then taxed at 40%.
Wow.
Ouch.
Yes. Hefty.
Yeah. Normally between spouses there's no inheritance tax. So if one partner dies and leaves wealth to their remainder, their survivor, there's no inheritance tax at that point, but there is then moving downwards. There's ways of avoiding that, which we'll come on to.
Okay.
Now a lot of people think there's also a £500,000 allowance because each person of a couple gets £500,000, and this is a government's attempt to introduce a stealth tax by making it first of all sound really attractive, that we've raised the allowance between a couple from 650 to £1 million. Well, that extra amount, the 175,000 each, is in respect of residential property.
Right.
So if your property is not worth the 350, you can't claim the full 350, so it doesn't help less wealthy people.
Okay.
And if your estate is more than 2 million in total, you start losing that 350. So it doesn't help people at the other end. So there's a small bracket in the middle that will benefit.
The sweet spots, that's where you want to fall into.
Yeah. And so that 40% tax, it has to be paid as soon as somebody dies.
Okay.
So they're executors. Last time we talked about wills. The will appoints an executor, and the executor then files for something called probate. Basically listing all the assets that that person had. And the taxman will then do a calculation, and that tax has to be paid before the estate can be released.
Right.
Okay, so if you're thinking, well, I'll take the money out from the bank account or I'll sell a property, you can't actually do that.
You don't own it.
Because you don't own it.
Right.
The first person, that's the most important one, is the taxman.
Okay.
And so once the tax is paid, then the estate can be released. But if you don't have the monies yourself to pay it, you might need to go and get a mortgage. Not a mortgage, but a bank loan. Banks know you're in trouble. They're going to charge you the earth. So then you'd borrow money to have the money to pay the tax, to get the property to sell it, to then have the money to pay back the bank. What if you can't sell the property quickly enough?
Right.
That loan is racking up. And so people need to be aware of this tax. How do you avoid the tax is probably your next question, Vishal.
You read my mind. That's exactly it. So we now know about this tax.
Yeah.
We pretty much straight away have established that we don't like this tax. How do we get around it?
Okay. So there's a couple of things that we must do. First of all, understand that the easiest way, I say easy only because on paper it looks easy, is don't own anything. Because if you don't own it, you're not going to get taxed on it. So you could give it away, give it away to your children. Problem, once you give it away, you can't continue to enjoy it.
Okay.
That's the first problem. There's a number of problems.
Because you don't own it.
Because you don't own it.
Right.
Now again, I'm going to pick on something because I'd say every 2 to 3 days, I meet somebody who has made a mistake. And I bet there's viewers right now who are going to say, oh my God, that's me.
That's me, yes.
They think because I need to get rid of things to reduce my estate, and there's a 7-year clock. In order for you to give it away, can't be on deathbed, because it's too easy.
Yes.
You've got to give it away and survive 7 years. So they say, what I'll do is to start the 7-year clock, I'll add my son or daughter to my house. That way I've given away half my house, therefore I've reduced my estate. Not if you don't pay them rent.
Right.
So many people do this. They do it with their homes, they do it with investment properties, they even do it with their bank accounts. If you add your child to that asset, but yet you continue to enjoy it, it's called a gift with reservation. You did make a gift, there's no doubt, but you reserve the right to continue using it. So if you're living there without paying a commercial rent to your children, who then have to pay tax on that rent, by the way.
Wow.
Okay. The 7-year clock never starts.
Okay.
So I took straight to camera. If you have added your children to your property thinking you've given it away, take some advice urgently. Your 7-year clock has not started. I can't say that strongly enough, right? Because I see it every other day. So giving away assets. You could invest in certain assets that are then qualifying. Now, if you own a business, a trading business, it might be worth £10 million or whatever the value is. There's an exemption for that. Okay, so that's useful to know.
Yes.
There's other exemptions. You could give away £3,000 a year immediately, and that's per person giving, not person receiving.
Yes.
And that's immediately exempt. There's no 7-year clock. But ultimately, people who have created wealth run out of ways of giving it away. Because they can't give everything away, because then they've got nothing to live on.
Right. Yes.
You know, if I give away a property that's rented, I can't have the rent.
Yeah.
By the way, it gets worse. Okay? If you bought that property cheaply and it's gone up in value, and you now give it away, you also pay capital gains tax.
Right.
Okay, because you gave away an asset.
Yes.
And you might say, well, I've got no money for it. It doesn't matter. You crystallise the capital gains tax.
Yeah.
Another little tip, capital gains tax dies on death. Okay,
Right.
so if you have got an asset, it's gone up in value, that would have got taxed if you sold it. If you hold it until death, capital gains is wiped out, but inheritance tax appears.
So inheritance tax, nobody wants it. How do we sum this up then, Bhupinder? How do we get around this by still making sure that we are leaving sufficient assets to our children?
Interesting ways of doing it. I think in our next session we're going to start talking about trusts. And trusts are a great way of passing your assets down whilst protecting them. So giving things away is a good way of dealing with inheritance tax. One of the other ways, and we'll talk about it in the future, is to use something called a whole of life insurance policy. That way, instead of giving away the full tax on death, you're giving away a small amount every year.
Right.
And on death, the money appears through the insurance policy for the children to pay the tax. Next week, when we talk about trust, we'll talk about how you wrap a trust around life assurance, and that's really creative.
Brilliant. I look forward to it, Bhupinder. Thank you very much for coming onto the programme. We'll see you again next week.
Hopefully in drier weather.
Thank you very much, Bhupinder. And of course, he'll be back again on next week's show to talk to us all about trusts. Time to take a very short break, but when we come back in part 2, we'll be back with some more home cooking inspiration. We'll see you again in a few moments' time.